Okay, great. Thanks, everyone. I think we're all here. So we're just going to talk a bit about investing, building wealth for the long term. At just high level, of course, this is a topic that has a lot of elements to it. So I'll just start with a bit of an overview, and then Denine will go into some of the specifics of some of the products. But I think the key thing when you think about investing or building for the long term is patience and planning. And if you just keep this in mind, then you will not fall into all the traps of get-rich-quick schemes and it's too good to be true, because if it's too good to be true, then it will be too good to be true. And then you will get hurt, like a lot of things. So just as Mr. Buffett said, someone's sitting in the shade of a tree today because someone planted that tree a long time ago. And that's the way it works with building wealth for the long term. It's not about a quick thing. It's about a lot of the people we see. The guy was a lawyer. He was a lawyer all his life. He just put away his sort of extra bit of savings every month. And today he has more than 100 million rand in his balance sheet. He's just a lawyer. He didn't do anything amazing, but he's 65 and he just over time put in the money. And that's the thing with building wealth. It's patience and planning. And that's also where the budgeting comes in. So at the start of this journey, you start off with budgeting and goal setting. So obviously budgeting was discussed. Very important in your budget, you don't save what's left after you spend. You spend what's left after you've saved. And that is crucial. So later on, I'll go through sort of a very high-level example as well, just to how to think about that. And then secondly is setting your goals. What are you saving for? Because this will help you to not get distracted along the way, and it'll help you to persevere sort of as you go through the journey and you build your wealth. So obviously, firstly, set your plan. What are you going to save for? What are your goals? So saving for retirement, of course, a good thing. Saving for a deposit for a house. Further education is always a good thing, or your children's education. These things will be investments. Saving to buy a new car every now and again. Just to get the best phone every 2 years, to go on expensive holidays. These things aren't investments, they're just expenses, and they'll make you poor in the long run. That's the fact. So setting your goals in the beginning, knowing what you want to save for is crucial, because that will help you as you go on the journey. And then secondly, patience and delaying gratifications. So they always say that finance has given us the seventh wonder of the world, and it's called compound interest. So, and just to give you an idea that sort of small amounts can make a very big difference. So here's an example. Started with 1,000, put in 100 every month at a 10% interest rate per year for 30 years. So sort of think about your retirement. You ended up with 246,000 at the end of 30 years. It's decent. You earned about 210,000 of interest over the 30 years. It's not great. You still started with 1,000, you still earned 10%, it's still for 30 years, you just put in 500 a month. So just 400 more. You end up with 1.15 million. From 250,000 to 1.15 million, just because you saved 400 Rand more every month. And that's the power of compounding interest. So that 400 Rand a month more, you almost had 5 times the amount of money at the end. And the thing is, 400, 300, 200, it's small amounts. You don't, I think where a lot of people sort of think is like, I have to save like this 5,000 Rand here and this 10,000 Rand here. No, if you can save, that's where the budgeting comes in as well. You identify your budget, you do your expenses, your income, you really like look at where's that 100, 200 Rand that I can put into a tax-free investment or your retirement annuity or anything like that. Denine will also talk about that soon. And you put that away. And in the long term, you will see the benefits of that. As I said, most people that I know that built wealth over a long time either got very lucky in the stock market, which doesn't happen very often, or they were patient over time. And then the final thing that I just want to say is remember that compounding works in reverse as well. So there are two sides to compounding. So when you take on debt, that is someone else's passive income, and they're returning that power of compounding interest on that. So someone is getting rich because you decided to finance your lifestyle. So always just be aware of that. Of course, things like a bond on a house, getting a car is important. If you have to pay for studies, I mean, those are good things, like I said in the beginning. But getting a car every 3 years, running your credit card into big debts, financing clothes, that type of stuff, you're just making someone else rich, and the power of compounding is making them very rich at your expense. So always just remember that. But then, so what do you do then with the money you decided to save in your budget? So I think we have to distinguish between sort of discretionary money and non-discretionary money. So money that you contribute to your pension and money that you sort of save, those things should be used for a specific type of product. But then I think there's also, you can sort of, when you've done your budget and there's like 500 or 1,000 Rand left at the end of the month that you can use for entertainment or anything else, that is sort of money that you're not going to sort of be on the street if you lose that. And with that money, you can maybe do different types of investing or gambling, if you will, or sort of very high-risk trading. So that's why I also distinguish between there's investing, which is very much patience long-term. Think about that. Then there's trading, often involving derivatives. Of course, like we've heard, that has some tax implications if it's not just capital gains, but if it becomes an income, you do it sort of regularly. That's much more high risk. And of course, you want to sort of know that if you lose that money, then you'll be fine afterwards. And then some things are, in my view, a bit like gambling as well. And sometimes it works out, and sometimes it doesn't. So I just gave the example. So when I was 2014, I was a trader on the derivatives desk. African Bank was falling. A lot of people said, let's see what happens. I put in 60,000 Rand. I lost all of it. But I wasn't on the street because of it, because for me it was sort of an extra bit. Then last year, Sasol fell because of COVID. Fell very sort of to a very low level. People were saying, oh, they might not make it. Too much gearing on the balance sheet, all of that. Put in 12,000. For me, that was sort of, okay, if I lose this, I'm not going to be on street. And it worked out. Sasol is back at 230 Rand this year. That's a return of like 8 times on your money. That's great. Or I didn't really understand Bitcoin investing, so I thought, okay, let me put 1,000 Rand into it, just because if you have skin in the game, then you'll start following it. And I was one of those guys that got in right at the top. So my 1,000 Rand is now worth 502 Rand. But the thing is, again, for me, that wasn't money that I needed to live on. And my other things like retirement savings, tax-free, my emergency fund, all of those things are in place already. And I'm paying off my bond sort of on my house. So those things are sorted first, and then you do sort of very high-risk things where you are willing to, it can go very well, or it can go wrong, but you're not going to be sort of destitute because of it. But in any case, so Denine will go through some of the specific things and how to think about it sort of in the long term.
Hi, everyone. I just want to go back to this again. Like Heerden said, it's very, very important to have a financial plan, and I think that's where you have to start off with. That's my day-to-day business that I do for clients, and that's the first part where we start off with a client is a financial plan. The important thing about the financial plan is the fact that there's discretionary versus non-discretionary money. When we talk about discretionary versus non-discretionary in your financial plan, we look at the elements of the fact that your retirement money is fixed within those vehicles until retirement, right? Until the age of 55. So we can't access those monies. It is in a liquid vehicle, so we need to leave it in there until retirement. Whereas where we sit with your discretionary kind of money, that's your tax-free investment, which is fully flexible, your emergency funds, your share portfolios, your unit trusts, those kind of investments. So it's very, very important, because the reality is when we work out a financial plan for a client, you've got financial goals, right? So if you want to buy a vehicle within 5 years, we will be able to use some of your discretionary capital to fund that vehicle. So saving within those vehicles, you can withdraw out of them to use that for your this or that goal that you've got in mind, right? But we can't do it with your retirement money. That needs to stay in there until age 55, according to the rules of the funds. But every company differs. There is certain circumstances that you can take it out. So yeah, I'm just going to get into the vehicles in a very, very high level thing, because it gets very, very complex out there. The financial world is very, very complex, and I think we'll be here all day long if I had to go into every single element, the tax implications of every single one, locally and offshore, the rules of everyone. But I just wanted to give you guys a bit of an indication of how it works and how we do it. So I think the most important thing where I want to start first is with the retirement savings. So some of you guys might get a contract with your company and you will get a pension fund contribution to your from your salary, right? So that is going to be a deduction before taxes are paid, which is quite beneficial to you. So you don't have to use your after-tax money to save for your retirement. So you can use your pre-tax money to save within your... so that will normally be a pension fund or a provident fund. Provident funds have been taken away, so mostly guys are invested within pension funds. There is rules and regulations of how much you can contribute on an annual basis, and that you can get into... you can just Google it. It's very easy to find it. I can go into it, but we'll be here all day long. And then the most important thing is, should you move from employer to a different employer, you are allowed to transfer your pension fund. So you can either transfer to your new company where you're going to work, depending on the rules of the companies, or you can start a new one with them and just save that into a preservation fund. The golden rule is, please don't withdraw your pension money and buy stuff. So because that's what we've been seeing. Whether you're 40 years old, whether you're 25 years old, we see that in this industry all the time. And then people can't retire because they spend all their retirement savings already. So like Rina has said, it's a tax deductible when you calculate your tax. So saving towards that is going to reduce your tax payable on an annual basis. On the emergency fund side, we would always suggest between 3 to 6 months of your monthly income must be saved within an emergency fund. A great scenario came through this past year with COVID, where many people had to move out of their apartments because they didn't save emergency fund capital, and they had to move in with their parents because they couldn't sustain their lifestyles. And I think that was an important lesson that a lot of people had to learn. You can't earn 30,000 and spend 30,000. You have to start saving. And yeah, in our current scenarios in our country as well, that's why the government is enhancing with tax deductions and stuff, because people are not saving. The ideal place to rather put this emergency fund is within a money market account or a deposit plus. Absa's got a deposit plus, or any type of liquid investment. I know Discovery Bank's got a few as well. Investec Bank's got a few as well. You must have access to that capital within 48 hours, and there mustn't be any withdrawal penalties. So that's basically where you would want to put your emergency fund in. Then on the tax-free savings, so every individual is allowed to invest 36,000 Rand per annum into a tax-free investment vehicle. You can start as low. I know some of the banks have a 200 Rand monthly payment amount that you can put into a tax-free. Most of the asset managers like a Coronation, Allen Gray, Old Mutual, those kind of guys, they've got a minimum of 500 Rand a month. So you'll need to start with 500 Rand a month. And my tip of the day is to please have a 10% increase on that monthly payment per annum. That makes a huge difference in the long run when you just add that extra 10% on your contribution. So let's say you started out with 500 Rand, is to just after a year then add that 10% allocation onto your tax-free investment. So you guys are very young. There's no regulations on where you have to invest in your tax-free investment. I know some of the banks are a bit limited to where they can invest, but if you go straight through an asset manager, you can invest anywhere. You can invest local or offshore. I would suggest to take your capital offshore. just because it's a long-run investment for you as well. It's a very, very long-term investment. So you can go and invest 100% in offshore equity, and you are not necessary to say to invest locally. Whereas, sorry, I didn't mention it earlier, whereas within a retirement savings, you are compelled to invest in South Africa. 75% of your equity must be locally invested, and the smaller portion can be invested offshore. They have increased it now that you can invest 30% offshore and then 70% locally. So you are bound to actually invest in South Africa only, almost, in retirement savings. In comparison to a tax-free savings vehicle where you can go and invest in global stocks. So a lot of guys are, some of the funds, if I can give an example, if you go through Alan Gray, they've got a fund on their platform. It's called like a Signia Fourth Industrial Fund. A very, very aggressive fund these days, going into robotics quite a lot, into AI and those kind of things as it's busy changing in our current industry and everything. And then also what they've added in there is the medical changes. For example, everything that happened with COVID now, the medical equipment that they use, has been in those investment vehicles as well. So if they start doing research and stuff on those different aspects of the medical equipment that they use, and there's increases and a greater demand for that, you get that benefit within your portfolio, and the dividends that gets paid to those different companies is reinvested back into your investment vehicle as well. So yeah, so you're only allowed in your lifetime to invest 500,000 Rand into a tax-free investment vehicle. So if you start saving now, round about, if you take the 36,000 Rand a year, it's around about 14 times, I think, and then you make up that 500,000 Rand. The great benefit with that is you're never going to pay any taxes on that, not on capital gains tax, not on interest, not on anything. So if you invest, let's say, 500,000 into your tax-free investment and it grows to 3 million, you're never going to pay any taxes on that increased amount where the capital has grown to. So I would say start out early and then start adding on to it going forward in your lifetime. I wouldn't even advise it even as well, because then your admin fees will just incur. So having 5 different investment vehicles, adding all of the administration fees of every single one isn't great either, because you're just adding more and more and more to it. So have one and build it up to 36,000 Rand a year. So it's a very good place to start off. Just a tip. When you withdraw out of your tax-free investment vehicle, so you are allowed 500,000 Rand in your lifetime. Let's say you've invested 100,000 into your tax-free investment vehicle and you withdraw 50 out of it. Your limit becomes 450,000 Rand. You are never allowed to go back and reinvest that money into it. So please don't use a tax-free investment vehicle as an emergency fund. When you withdraw out of it, just remember you can never put it back into it. You can, but you are just decreasing your lifetime limit on it. Okay, and then I just want to get into unit trusts and share portfolios. Guys, these get very, very, very complex. So you can either use a financial advisor to assist you with that, to open up your unit trusts and to decide on funds, or whether you want to go into a small share portfolio. There's a lot of platforms that you can use. A lot of people in South Africa are using, for example, the Easy Equities portfolio, a very low trading fees and everything on it, and admin fees. And within those share portfolios, you can then go and invest into different stocks. For example, you get Rand Edge stocks, where they generate their earnings mostly offshore. It's local, but they generate the earnings offshore. So whenever you see the Rand strengthen and the Rand weaken, you'll see some of those guys smile or don't smile as they used to. And then you could also just invest into local companies on the stock market there as well, on your share portfolios. A unit trust is normally where a lot of people invest into funds, for example. You get a Coronation, for example, Coronation Balance Fund. So a balance fund is it's a 4 out of 10 or a 5 out of 10 if I look at into in risk assessments. So mostly they will invest 60% in equities, 20% into a money market or so forth, and then 10% into bonds. They all split it differently, so there isn't a one typical way that most of the asset managers actually do it. So they all differ, and the asset allocations also differ. What you need to ask yourself is how much risk you want to take and how much are you prepared to lose or either gain? So the reality is a stock market or a unit trust investment is never a guarantee. You're never going to get any guarantees there. So you must be prepared to know that if you take the risk on it, you might lose some of your capital or you might gain. The important thing is that we would always suggest is the fact that if you take a lot of high risk in your investment portfolios, so for example, both of our tax-free investments is in offshore equity, we are prepared to be invested there for longer than 5 years. So I would always say that's a general rule. If you want to go aggressive, go more than 5 or 7 years in that investment portfolios. For example, your retirement savings would never be able to be more than a 5 or a 6 out of 10 because the government doesn't allow that. They don't want you to take too much risk on your retirement money. And then I think Heerden is going to talk a little bit about derivatives and Bitcoin. I didn't really work into that. I used to be a trader in commodities, so it was a little bit different. Not sure if any of you guys want to go and buy corn right now as an investment. So I don't think it's important that we need to go into there. But I think the important thing for me is, and something that I want to really encourage you guys, is to really go and sit, and when you do your budgets, is to really go and sit and think how much can you save going forward. It really is, like Heerden said, is we've got a financial tool that we built for our clients, and he always laughs at me because I get so excited when I actually just see the difference. When you structure your stuff correctly, according to tax, you minimize as much tax as you can and pay what you only should pay. And then the difference that makes in the long run on your portfolios. Like Heerden said earlier, I would rather invest 500 Rand a month more than have a 1,000 Rand phone contract. I'll just rather utilize that better. Or I had to get in a habit of you want something, but you don't need it, so you don't buy it. And like we always say, if you don't have the cash for it, just don't buy it. So exception to the rule is when you buy a house or so forth. So.
Well, I think I already said what I wanted to say earlier, really around the derivatives and Bitcoin. But the thing is, I think so. Obviously, those are very high risk. Returns can be very high, but don't put money into those types of things that you need to buy food with. That's ultimately like the important part. There's a place for them. So, asset management, you might hear the words, they often say also portfolio management, because it's a portfolio of assets. So that's why like all the things that Denine sort of went through. So you have retirement savings, and they might be some equity, some bonds, all of these. They're lower risk generally. Then you've got tax-free, maybe because we're young, you sort of put them in offshore, it's long term. You put cash into an emergency fund. So all of these build up a portfolio. Maybe you have some on easy equities, you've started buying a couple of shares over the years, or you will start. And they all form part of the bigger picture. And something like a Bitcoin or derivatives or whatever, they have a place in there. But the important part is, like I said in the beginning, so you must have a plan and you must have patience. So as you go down that list that we just had, the patience level goes down. So at your retirement savings, that's 30, 35 years. When you're trading derivatives, you're looking at it 5 times a day, because there's some serious implications if you get it wrong. So I think ultimately the point that we really just want to make there is like there is a place for everything, but consider holistically what the overall plan and picture is. And sometimes the risk reward is great. And like I said earlier, sometimes you make a mistake and you lose money. But that's the reality. The important part is just it must be money that you can lose. I'll say a quick word about it. So you can either have sort of, when you invest into funds, there are funds that are traded directly on the exchange, and they usually track an index like the JSE top 40 shares or so. And they're generally very cheap because it's just a fund, and the shares that are in them stay the same. Yeah, they stay the same. So there's no portfolio manager that trades the whole time that pushes up fees. But then you also get sort of unit trust that an Allen Gray Coronation or whatever would run, where they actively sort of identify opportunities and try and generate an outsized return compared to a benchmark. And those ones attract higher fees. And like you just said, of course, fees also have a compounding effect. So if for 30 years you're paying 2% on one fund versus 0.5 on an exchange traded fund, that 1.5% over time will also add up. The compounding effect of that can also, and that's also to the point why you shouldn't have 5 platforms, because then there's the portfolio manager's fee and there's a platform fee and all of that. And that's the beauty of also of easy equities these days. It's very cheap to trade on there. There are some, I mean, easy equities is very good if you're going to buy something and you hold it for a long time. Easy equities is not good if you want to buy and sell on the same day, because they don't have direct market access and you can't really see live pricing and order books. So again, there's a place for everything. But yes, in general, keep your fees low and do your plan to know sort of what your risk and reward is. Consider it as an overall portfolio when it comes to investing. But yeah, do you want to add?
I just wanted to add a note there as well, what you said about the cost. What is an also important thing is when the markets go down, it's to not sell out. Okay, so how many people sold out when COVID happened? The markets went down with 14, 15%, and they didn't stick the market out. They sold out, and they lost everything now with the recovery part. The market's always going to do this if it's very aggressive, guys. It's always going to go down. It's always going to come up. And I think the exact same point what you said with regards to the cost, you have to stick it out in the market. If you don't stick it out, sometimes you're going to lose on the recovery of it, and you're going to sell when it's not a very good time to sell out of the market. The best that I've seen in the past is when we go into recession or in the economy is to actually go and invest into equities, buy it at a low time, because a lot of people are selling out of it already, and then have the guts to actually stick it out until it drops a little bit more. It could be, but then if the recovery comes up, it's quite fruitful within your investment portfolio. Okay, guys, I'm just going to continue here. I'm not going to focus too much on this, but I just wanted to give you guys a few tips around this. Short-term insurance, obviously, when you have a car, it's very important to insure your car. I think when one is renting or staying at home or so forth, I don't think household insurance is important. So please stay away from that. Don't waste your money on that when you don't really need it at that stage. If we get to life insurance, so a lot of you might get employed by a company and would have it as part of your group life cover. So you could always just go to your HR and ask them, what is your group benefits? So then they will tell you you've got life cover, you've got disability cover, and so forth within your group benefit scheme. You might also see in that what is your retirement savings amount then as well when you ask them for the general group benefit statement. I think the importance for me is, and exactly what Philip and I spoke about earlier, is don't go and take a life cover out at a young stage if you don't have any debt and it's not necessary to have it. Rather use that money and to save it into emergency fund or a tax-free. Just use it in the right vehicle. Whenever you get into a different phase of your life and you are married and have a house or maybe with debt, or even not married and you have a house with debt, ensure that that debt is covered in the instance should you pass away. Please just remember the calculation isn't just just the liability that you're owing. Could go into your estate, it could be executors' fees, and that should increase your life cover amount as well. It gets very complex if I had to go into all of that, so I'm just going to talk really briefly about that. And then disability and critical illness cover, I think a lot of people will differ with me with regard to that, but I've just seen too many incidents in my life, right? So I'm not saying that's going to happen. We pray the blood of Jesus over every single one of us. But you walk out of here, you become disabled, and your parents have to take care of you for the rest of their lives. Let's say you can't work again, and you used to earn an income of 20,000 Rand a month. Your medical expenses are high. Your parents maybe can't even afford to take care of you with all of those medical expenses. It's very important to have a lump sum disability cover or a monthly income protector in place. For me, disability is really important. We actually had a guy who was with us at university, got disabled in our third year at university, and financially ruined his family because they couldn't take care of him on a disability side. Guys, it's very, very expensive. You need to change your house. You need to get a wheelchair. You might need to get a ramp or two for the wheelchair to get into the house. Or maybe you lose both of your eyes and you could never work again. So you need to think of that, right? So it's very important. So once again, it is a benefit that some companies will give to you in the form of either a lump sum payment or a monthly income protector payment on your disability side. And the general rule is normally that your disability must replace 75% of your net monthly income. And you can go and calculate on your own basis. Or what you could always do is, let's say you've got a property and you've got a bond of R1 million and you earn R1 million a year. Try for your lump sum disability cover then to be 2 million at that stage, that it could help you to actually sustain one year of your, let's say that it was your income on that stage, and then also pay off your bond, so that you don't have to worry about where you're going to stay. You can actually pay off your bond with your lump sum disability cover, and then also be covered for those months when you are disabled. Not necessarily saying you're going to use all of the money at one stage, but what you can also do is then to invest some of it, and the others you could use to just live off for that while. So for me, disability cover is really important, and it's not that expensive when you get it at an early age. And then the other one is critical illness, which is very, very critical for me. Let me just define critical illness. So that is whenever you get cancer or a heart attack. It must be a severe illness. That's how they define it as. So you say you're young, you say you're healthy. We've seen 30-year-olds getting brain tumors. We've seen 32-year-olds getting heart attacks because of the stress environment that we all are in these days. So I would say if someone approaches you and you want to get that, start off with 200,000 or 300,000. Really, don't start out with 2 or 3 or 5 million rand. It's going to cost you a lot of money, and you don't really need it. And these help as an addition to your medical aid. So your medical aid, for example, is going to pay a certain amount, and your critical illness will be covered by the rest. So in our instance, we had a friend who had phase 2 cancer at a very young age, and her medical aid only paid a portion of all the expenses. So she had critical illness cover in place that paid out, and that assisted her to actually recover very well and also get the best chemotherapy that she could get, because the medical aid didn't cover all of that. So an important thing to remember, and also what's been happening in the past is a heart attack could lead to being disabled. So then in both instances, you'll get a payment out of that lump sum amount. Okay. Guys, there's no general rule really around critical illness. I would say look at your affordability level in your budget and then see what you can actually get it. But if you get it at a younger age, it is better because your premium will be low. And then if you take it out at a later stage in your life, it becomes more and more and more expensive. Critical illness is one of your most expensive benefits with your own personal life insurance.
Yeah, so I think the important thing on the insurance is don't be overinsured, because you will get contacted all the time to take out life insurance and this insurance and that insurance. And there is a place for these things because life does happen. But if you, for example, have group life cover with your employer, don't even answer the call when people want to sell your life insurance. If you don't have a house with contents, don't take out short-term insurance. Critical illness obviously is, so I think my critical illness cover is about 500,000 Rand, and it costs me 150 Rand a month. Yeah, so the thing is with so I pay less, so the total amount is about 150, but like if you're on like a diamond status with Discovery or a private status with Momentum, whatever, they give you sort of a cashback on that. So I end up paying like 70 or 60 Rand a month for it. But if you didn't have that, it would be like 150 or 160 Rand for 500,000 of cover. And like she said, that's just if something happens, you have hospital expenses, and it's to cover that. But important, yes, don't be overinsured. But again, if you think about overall wealth creation, long-term, protecting yourself, there is a place for some of these things. But like Denine also said, every 150 Rand that you unnecessarily pay to life insurance is 150 Rand you could have put into a tax-free saving. So there is, again, overall a plan. But what I now just want to do is sort of a quick example. So if you think about almost the budget that we had earlier. So these numbers are very high level, and I know it doesn't include everything, but just to give you an idea. So say you start your job, you get 300,000 Rand a year, 25,000 a month. Great. Then, like we said, pension and medical will be deducted before tax. So what I just said was, okay, you're contributing 10% of your gross salary, so 2.5, and say your medical is another 2.5. That's yeah. So if I'll add that. Thanks. So this is for typically you work for a company where they do sort of all of these things. If you're a commission earner, or some people with the company doesn't contribute to a pension and you need to contribute to an RA on your own. I'll touch on that now. So then you have 20,000 left. Say you get taxed at 20%. Then you have your net income. Then I put in tithe here, and here I don't want to get into that. Some people tithe on gross income, some on net income. It's up to each. That's not for me to say. Again, cheerful giver and what you feel in your heart. But in any case, then like I said, in your budget, first put in how much you're going to save. So you mustn't save what you have left after all your expenses, because then you'll never save, because you will use up all your money every month. First, put your savings and then live off the rest. So then as a rent, car payment, insurance, food and fuel, and then you have like discretionary income. And the way to think about the hierarchy of investing. So you're contributing to your pension right at the top before tax. Then with this savings here, you're saving away for your emergency fund or putting in a tax-free, or if you maybe bought a house and you're paying you want to pay additional into your bond over on top of this, say 4,000, then you do it with that piece. And then very high risk type things, there's a place for that, but you use your discretionary income for that. You don't use something up here and suddenly you lose 2,000 Rand and now you can't buy food that month. But there's a place for it in the bottom. So you can either go to the restaurant or buy something that's very high risk. So that's sort of how I think about your overall budget and how you should think about these things. And then I'll just give you my personal example. So for me, my company contributes to my retirement annuity before my tax. So they contribute 10% of my total gross income to a retirement annuity. Then we have saved up an emergency fund for both of us, 3 months income. We keep that in a 24-hour notice deposit that's very easy to access if anything goes wrong. So for us, that one is done now. So if we're then further on this line, so we do it a bit differently. Denine contributes every month to her tax-free so that she reaches the yearly threshold of 36. I, on the other hand, sort of because I'm a salaried worker and she's a commission earner, I tend to get a bonus. So I do mine as a one lump sum. When I get a bonus, I put 36 into my tax-free. But then in this line here, so what that means for us now is we bought a house in December. So this additional piece here, so I still pay my bond every month, but the additional piece that I want to save, I put into my bond every month. And then, like I said, I do have discretionary income, and I have made good and bad trades on it, on very high-risk things. So, again, there's a place for everything in a plan. That's why I think initially when I said, so you have patience when investing, but you must have a plan, because it's an overall portfolio. And then maybe just one thing, like Denine mentioned, is so if your company doesn't contribute to a pension for you, it is, so for example, my sister was in this sort of case. So it is worthwhile to go to them, to ask them, if I open a retirement annuity, would you be willing to contribute a piece of my pre-tax salary to that retirement annuity? Go and ask them if they don't do it. Because everything below this line is post-tax money. So you have paid tax on it already. So if you put it into the tax-free or your bond or anything, but if you can get your company, if they don't already contribute for you to a pension, to contribute to maybe an RA before you pay tax, then that's very beneficial to you. So as I said with my sister, they didn't contribute. She went to them. Denine helped her. They opened an RA. And now the company contributes pre-tax money into her RA, which is great. So yeah, I think that's it from us. But of course, I'm sure there are questions, and there are a lot of things that one can discuss here. So we'd be happy to take any questions you have. But I think ultimately that the keys are in wealth creation, think long term, and have a plan. Things are a portfolio. You shouldn't consider each thing on its own. And the budget is basically the starting place of a good investment journey. So, yeah. But any questions?
Sorry, guys, I just want to make a note before we start with the questions. Exactly what you said earlier with regards to the rental property. Remember, this is our primary residence. We want to pay it off as fast as we can, so we don't have to give the bank pay too much interest on it. Therefore, we see it as a very, very good investment for us, and that's why we've decided that Heerden needs to all of the discretionary money that he's got, he needs to invest it into there. Whereas when you've got a rental property, it could be different because of the tax implications on it. So once again, like and I just want to reiterate it again, every single person is going to be different according to your circumstances, your financial goals, your financial plan, the way your salary is structured, the way you earn. It's going to be on a case-to-case basis, so nothing is set in stone. Yeah. So any questions? Philip, I'm not going to, I can repeat the question. Can I assist you on a personal level? Unfortunately, I won't be available. I only work with high net worth individuals, but I could suggest someone to you. And if there's any more cases like that, Philip, I would more than gladly to give a few numbers out where they could actually go and consult with the guys. Sorry, I've got a very specific field and category that I work with. Yeah, so unfortunately I won't be able to, but I could advise someone that could assist you with that. And I agree, like we said, I'm not a medical doctor. That's why I go and see a doctor to help me with those kind of things. And you get people that, can I say, are specialists in their fields to assist you with all of your finances and stuff. So our backgrounds. So I studied investments at Tux, and after that I worked as a commodity and equity trader at Absa Capital, and got very bored with screens and working with computers all day long. So I wanted to work with people. So I got into private banking in Absa and started as a wealth planner for clients, and specifically on the high net worth individuals. And out of the bank, everything became very complex, and I wanted to be an independent person. The reality is the bank moved into a sector where we had to advise only their funds and their platforms, and I always want the best interest of the client. Anyway, I studied further in Certified Financial Planner, and I've did a post-grad now in tax as well, and I've been working for AdviceWorks. We're an independent firm for the past 6 years? Yeah, 6 years. Yeah, almost 6 years. Yeah. So yeah, I've been, and I have my own business within them. So yeah.
I also studied investments at Stellenbosch, and then I worked as a derivatives trader at Sanlam Private Wealth, and then went to study abroad, political science, which has nothing to do with this, and also an MBA. And then I worked in mergers and acquisitions advisory, so investment banking, which actually does not involve investing at all. But yes, worked in investment banking. And then currently I'm working in management consulting. But yes, very much also finance background.